Hello everyone, welcome back. In this video, I'm going to go through what is trading. Okay, so there are going to be three parts to it. Introduction to trading, basic trading terminology, and key points. So it's not going to be too much or too in detail, but I think it's necessary to just have the core understanding in place, especially for people who are completely new. So let's get right into it. Introduction to trading. 6 parts to this, 6 slides pretty much. The definition of trading from a general and financial markets standpoint, the evolution of trading, old days compared to modern times, and the types of markets and instruments that you can be a participant in, and the actual market participants, like who is in the market, who's trading, right? So this is the most primal definition of the word trading, right? It's a very general definition. At its core, trading is the buying and selling of anything. Most of the time, one end of the transaction involves currencies. For example, you go to the store and you trade your money for a soft drink or a loaf of bread, whatever it is, or you buy a car. You're making a trade, and usually there's money involved. For example, or you provide your time and skills at a job in exchange for money. So your employer is giving you money, or your client is giving you money for your time and your skills. Okay, so a trade is always occurring. However, a trade can be made without money, such as trading Pokemon cards with friends, for example, or whatever it is, right? What is important to remember is that there always needs to be a counterparty to any trade. You can only buy something if someone else is selling it, and vice versa. This is going to be the same for, how we will be trading in the financial markets. There always has to be a counterparty. So you're always making a trade. Trading the financial markets, the trading that we will be referring to is of financial instruments. Okay, so things you can trade such as forex and stuff. We'll go into that later. So the aim is always to buy something and sell at a higher price, or the other way around. So you can actually sell something you don't have and buy at a lower price and make profit that way. An easy way to think about it is you're just betting on the price going up or down. It is about capitalizing on those price fluctuations. So the motivations for trading can vary widely among individuals and institutions. So ordinary folk, many people nowadays can trade, and trading is also done by banks, hedge funds, trading firms, etc. Some trade to supplement their income, others do it full-time as a profession, while large institutions may trade as part of their investment strategies to grow wealth or hedge against other financial exposures. For example, banks, if they kind of know that the US dollar is gaining in strength, will be going up, normally they will short it, so they will bet on the price going down because their business relies on the price going up. So they're basically hedging their risk, you could say. The evolution of trading, how it was in the old days. In the old days, before modern computers and smartphones, trading financial instruments was a much more manual and localized process. So there was like trading, you've seen movies. There was like trading pits, New York Stock Exchange, which had an open outcry system, which is basically, traders literally shouting their bids and offers, and using hand signals to be more efficient in a noisy environment. So that's how they would trade compared to us now, right? Other methods were using a phone, not a mobile phone, but like a landline. At that time, there wasn't any useful mobile phones, and they would call up their broker to place an order, okay, or they would send a mail, literal paper mail, or have face-to-face negotiations. Obviously, it was a very slow process. Sometimes, it takes days to enter a trade or even to receive data about the market. You'd have to wait. Nowadays, it's very fast, as you will see. So in these modern times, practically everyone has access to live data from a plethora of financial instruments from the palm of their hands, aka their phones, laptops, whatever. Orders can be placed instantly, and close instantly. It has become a very efficient process as well as accessible to everyone. So anyone with a mobile phone can trade pretty much. Not only that, but there are now more advanced tools and forms of data that can be utilized to analyze the markets. Automated trading is more prominent with being able to use AI and all these algorithms. Albeit actual successful algos are quite invaluable, as in they are quite expensive. So, trading is a form of, as you'll soon understand, it's a form of printing money. So having an algorithm that just always makes money, this can be scaled with whatever amount that you want, because it's all in percentages. So it makes no sense that someone's selling a successful algo for like $5 on like Facebook with a 90% win rate. These things are simply, it's just marketing, and it's simply not true. Okay. Types of markets and instruments. So we have the stock market. It is a place for buying and selling shares of publicly traded companies, such as the New York Stock Exchange or NASDAQ. So if you want to buy shares in Apple, Microsoft, etc., all these different companies, that's in the stock market. Number 2 is the forex market. So you can trade currencies as well, such as the euro dollar. So the euro against the dollar, pound, those are the majors, the yen, Canadian dollar. And there also is minor pairs as well, such as the euro against the pound, etc. So basically you can trade any pair, a pair of currencies. Number 3, we have the commodities market, which is gold, silver, all these oil, platinum, all these types of commodities basically. The key exchanges include the CME, which is the Chicago Mercantile Exchange, and the London Metal Exchange. Number 4, cryptocurrency market. So I'm sure everyone knows crypto by now. So it's a new thing that people can trade, right? It's a digital market for trading cryptocurrencies like Bitcoin, Ethereum, and there's many other altcoins on platforms like Binance, Coinbase, KuCoin. There are quite many, but those are the 2 major ones. Market participants. So who's participating in the trading game? So we have retail traders, you, me, basically. Small traders that are not trading extortionate amounts of money, like banks, for example. Number 2, we have institutional traders, large entities like mutual funds, pension funds, hedge funds that trade significant volumes. So I can't remember what the number is, but after a certain amount, if you're trading a certain size, you have to report your positions. It's just the way it is, and this sort of data can be seen online as well in the Commitment of Traders report. Number 3, hedge funds, which are private investment funds that employ various strategies to generate high returns for their investors. Number 4 are the market makers. Okay, these are firms that provide liquidity. That's a term we will go through quite a bit more later, by continuously buying and selling securities, profiting from the spread, basically the difference in price. Brokers, intermediaries that facilitate trading for retail and institutional clients, earning commission and fees. So brokers are basically, if you're trading forex, for example, there are brokers such as Oanda, forex.com. These are basically like marketplaces where you can go and trade. Regulators. So these people aren't really trading, but they're government agencies and self-regulatory organizations that oversee and enforce market rules to ensure fair and transparent trading practices. Okay, so they're like the police of the trading world, and they regulate things and come up with rules and laws. Now we have basic trading terminology. So trading time horizons, number 2, ways to trade, and number 3, trading fees. So trading is quite flexible in that you can choose your time horizons, and you can base this on your lifestyle, your personality, or whatever it is. So the longest time frame is considered investing. So these type of trades last for years, basically. Much of investing relies on fundamentals. Position trading, number 2, it's almost like investing, but basically the trades that last for months or even a year. or two. And they also rely heavily on fundamentals and long-term trends, although you can apply technical analysis as well. Swing trading is third, slightly shorter time frames in that your trades can last from a couple of days to several months. Normally a few days, I think, on average. If it's lasting several months, normally if you're doing that often, you'd be considered a position trader. So more technical analysis can be applied to swing trading, or entirely. You don't even need fundamentals. Number 4 is day trading. So these trades are usually settled within the same day. So you get in a trade and you get out. Fundamental analysis is usually limited to economic news events on the day itself, so you're not too concerned about climate change or something like that, right? Number 5, scalping. Though these are the shortest time frames. Trades capitalize on very small fluctuations on price, usually lasting seconds, minutes, or a couple of hours at most. So we have ways to trade as well. As I put here in the notes, there are many types of ways to trade. So these things are kind of like games in a casino. You could say trading is a casino, the market is a casino, and all these little instruments are different games you can play in a way, but they all usually revolve around price going up or down. So first you have CFDs, which are contract for difference. They basically allow traders to trade underlying assets without actually owning it. It allows for trading with leverage, small position sizes, and shorting. Okay, so you're not actually owning whatever you trade. For example, if you buy gold, you're not actually owning the gold. You're just it's like you're basically betting, okay, on the price going up or down. Number 2 is the spot exchange. So this is actually owning whatever you buy. So the spot market allows you to outright own the asset. So minimum position size are often larger than CFDs because you actually have to own what you're buying. Nobody's going to sell you $5 of gold if you're trading in that small amount. So basically, you can only sell what you own, and you're not allowed, and you can't short because you're actually outright owning it. Number 3, OTC, which is over the counter, is a direct trade with an individual. So instead of a general marketplace where everybody is kind of trading bits and pieces with each other to fill their trades, OTC is just a one-on-one exchange. So there are companies that facilitate these type of transactions, but generally so the type of trading we'll be doing is not OTC. So we'll be trading pretty much CFDs most of the time, or what you'll be trading anyway. Number 4, futures and options. So these are derivatives, as in they're based on underlying assets, such as they can be futures for gold, futures for Bitcoin. They're based on betting on the future price of an underlying asset. It's slightly different in which you'd get in and out of a trade. Futures are betting on a price, months down the line at times. Number 5, binary options. Same as futures, except that you're just betting on the price either going up or down. So you have two options. You can either say that the price is going up or it's going down. And if you say it's going up and it goes up, you make money. If you say it's going up and it goes down, you lose money. So it is risky in my opinion, but as long as you have a strategy for everything and you trade on a reliable exchange, everything should be okay. Trading fees. So I think it's good to know how brokers and such make money, and it's important to understand some of these things as they would apply to how you would calculate your profits and analyze your trading strategies. So firstly is the spread. So the spread is the difference between the bid and ask price of a financial instrument. The bid and ask price are basically the lowest price you can buy and the highest price you can buy at that moment. Highest price you can sell at that moment. So if you want to buy something, usually it's more expensive than the current price, and if you want to sell something, usually it's cheaper than the current price. So the spread, as in the gap in between, is how some brokers make profit, and it's important to understand that. So let's say you're getting in a trade and suddenly your entry is it's way further than where you actually intended, especially if you're trading on a very small time frame. And those kind of things can affect you, your psychology, your strategy, and etc. It's important to know because these things fluctuate as well at certain times of the day or during news events. Number 2, commission. Commission is just a percentage of a trade that is paid to the broker for both entering and exiting a position. So if you're paying 0.1% to get into a trade, it's going to cost you 0.1% to get out as well, to close your position back to whatever currency that you're trading. So that's also one way that they make money. Number 3 is swap fees. So these are charges incurred for holding a trading position overnight in the forex market. And number 4 is data feeds. So these are just like extra features that you can pay for. Some platforms charge additional fees for premium data. For example, if you want data on up-to-date data on the futures price rather than having to have 10 minutes delayed data, sometimes you got to pay for that, or some offer additional tools, algorithms, etc. So here are some key points to remember. Number 1 is trading is a zero-sum game. So what does it mean? Like I said, each trade has to have a counterparty. So it always ends up at like 0. You're just making a trade. And you'll see that this is important later on as we talk about things like liquidity and how the market actually moves and why it moves. Number 2, practically anyone can trade the financial markets nowadays because of the technology you have. So not everybody, but many people are trading. People as young as, sometimes 14. Number 3, trading is flexible and can be catered to each individual's lifestyle and personality. This is important to keep in mind. Trading is not this lucrative thing that only a certain class of people can do in the sense of being intelligent or wealthy. Okay, so it's quite flexible. There are many ways to make money now, including like prop firms. The type of trading you do can be catered to fit the lifestyle that you have, right? If you have more free time and you like a fast-paced trading style, then you could be a scalper. If you want to do it as a part-time endeavor because you already have a job, then you could try swing trading. And if you're already busy running a business but you still want to trade, you can always do position trading. Okay, so it's very flexible. Number 4, the house always wins in general, but the trader decides if he wants to be a professional or a gambler. The house always wins is a term referring to casinos. So a casino, there are times where people win jackpots, but the casino doesn't care because the statistics are rigged in a way that they will always outprofit their losses. And the same thing goes with trading. You want your wins to outprofit your losses and you want to scale that way. Lastly, there's always risk involved, but this is something wealthy people and entities are involved in. So your success depends on your approach, right? So yes, in trading, there's always risk. It'll never be without risk, and I think nothing in life is without risk. Even working at a job, you can always get fired. So there's always risk. But in trading, yes, you can lose all your money if you decide to. But trading is something the wealthiest of people and entities are involved in. Okay, so they're not gambling their money. They're not stupid. They're not being frivolous. It's something they use to make even more money. And you can do the same as well. But of course, it all depends on your approach. So that's it for this video on what is trading. Some basic simple stuff. If you want to learn more, you can go on websites like babypips.com and they have a great course there where you can study and learn more. And of course, you have Google, you have ChatGPT. There are plenty of ways that you can educate yourself more about what is out there. But what I've given you is the general terms and ideas for now. Okay. So I'll see you in the next video. Until then, take care.